it's nice to hear other speakers and folks that have had experience in the marketplace that have come to some of the same conclusions and suggestions as to things to do, things to not do, the good, bad, and the ugly, like Ferris has talked about. As far as forecasting goes, in the last panel, I talked a little bit there at the end about, my gosh, if we can just figure out where things are going to go. I had the pleasure a few months ago of putting together an event with Stephanie. She did all the work, but we have a good friend, Dr. Doug Duncan, whom I think Mauricio has met, and some of you, who's the chief economist of Fannie Mae. And he has been voted by some organizations as the most accurate forecaster in the past 5 years. So my first tip of the day is go to the Fannie Mae website, and there's on there, he publishes to the public, which a lot of people don't know, his predictions and what's going on in the marketplace. And he has accurately called every single rate change in the last 20 years. So, all right, that's my tip for the day. Operations is certainly indeed a critical element, as was expressed on the panel. Kenny McElroy, how many of you know of Kenny? Kenny kind of prides himself in having come into the real estate world from the operations standpoint, and he often emphasizes how important that is. So yes, the best underwriting and the best everything is best market, best product is only as good as you can execute it, right? You really need all the legs of the stool to be able to have something come off successful. Kenny, if you've met him or seen him, he's a very, certainly does not wear his success on his cuff, but he couldn't help it a few years ago, and he splurged and bought himself a beautiful red Ferrari, and on the license plate it has C student. Let's see, we have slides working, here we go. I'm going to talk a little bit less detail about real estate than, say, Ferris did. Talk a little bit more about, things that I've learned over my years of investing. Tell you briefly my story, but talking about crossroads and major events, and what are some nuggets that I've learned along the way that I want to share with you. Everybody here can probably think of some event in their life, some person in their life that at the time you didn't realize how important it was, but later on you realize, my goodness, if it weren't for this event or this person, my life would have been quite different. Can we all think about things like that? So it starts with your parents, right? Choose your parents carefully. Well, unless Elon comes up with some way for us to time warp back, it probably won't quite happen like that. But what we can choose is, what do we learn from them, right? What did they model for us? And which things do we want to continue with, and which things do we want to change? It might be they're very witty, or they inspire us to be curious, or maybe there was an addiction problem, and all those things we can continue with those models that we see, those characteristic behavior, or we can choose to change it, which isn't always easy to do. But be conscious about that, and it's not just your parents, it's anybody else that you associate with or have. One of my first great decisions was the partner that I picked that turned out to be my partner for 52 years until I lost her 6 years ago to cancer. And it turned out to be a good decision. The night that I went up to her and asked her got up the nerve to ask her to dance, and she said yes, that was the beginning of a great relationship that certainly, I was very introverted at the time, and she was a bubbly extrovert, and she taught this engineer to enjoy people more. And in later years, she said she wasn't sure that had been such a good idea. One night, I was a ham radio operator. Everybody know what a ham is, an amateur radio operator? At age 12. Boy, that was a good thing that happened to me. So as I was in school finishing my EE career and wanting to kind of explore a bigger world, I went to on the air and talked to a lot of people out in Northern California that said there was an emerging electronics industry, and you might be interested in exploring this. And I was also a big fan of the Beach Boys. So little did I know that one day I'd wind up getting to know the Beach Boys and getting to go backstage with them. So that was a fun thing to get to experience, considering that they were a factor in my making a move out. So one night at dinner, I asked my bride, "Honey, what do you think about going to California?" Now, this is back at Delaware, University of Delaware. She took one more bite of her dinner, and she looked up and said, "Okay." So coming out to California turned out to be another great idea. And Fairchild, which I started with, which was the start of the semiconductor industry, as we were talking about last night. We have some other techies here that started off early on in that business. So the landlord, I went to get my keys from a rental house. Turned out the landlord was in San Jose. Landlord lived next door, and turns out he owned 10 houses on the street. He was 38 years old, no college education. He was financially independent. So this is 1969. So what do you call a moment like that? Yeah, that's an aha moment. But you know what? I was told by a number of people that it was a bad idea to buy a house because prices had gone up so much in the 50s and 60s they couldn't imagine to go up anymore. I was also told that what was to become Silicon Valley had its run. It was all over. All the jobs are going to Japan, and I'd missed it. I didn't believe either one. I've always been a contrarian, I think. I like to think a calculating risk taker. So, right, that's one thing that separates us, I think, who've invested in real estate, is that a lot of people, they just can't get comfortable enough to try anything different from what they perceive as safe, like a mutual fund. But, I think you have to be willing to take some risks, but as we all know who've been in the business for a while, you don't just put your chips down on the table. You go do some serious calculating. So I bought this house anyway as the first rental, and my wife's hand was shaking as we signed the contract, and knowing that we'd only eat hot dogs and baked beans the rest of our lives. And but I convinced her to go ahead and do it anyway. We paid $30,200 for that in Silicon Valley in 1970. It rented for $300. That ring a bell? Is that about 1% per month of the value of the house? Yep, you could actually do that in California back then. After 30 years in high tech and 2 startups that failed, most startups fail, right? Not according to the headlines, but they do. So as any venture capitalist will tell you. So after 30 years, I realized one day that I was earning more money from the rentals I bought in the 70s while I was sleeping than my day job and stock options were. But I also realized that my house that I bought for $30,000 that was now worth about $500,000 was only making about a third the revenue that it was when I bought it. So I studied the country and looked at that. So this is before internet was quite as prolific as it is today. But I studied the country, and Dallas came out on top, and Dallas-Fort Worth came on top of that. What did they have? They had still 1% ratio. They had broad-based economy. There's a high population growth, high economic growth, companies going there, business-friendly. It worked out very well for me. So I started selling properties in California and exchanged them into properties down there. I bought 13 duplexes for one house in San Jose. I bought a 68-unit apartment house for one house in San Jose with no extra money into it, and learned the power of leveraging and the power of 1031 exchange. and that turned out to be a good path. So I took the typical progression of going from houses to 1 to 4s to multifam to then non-residential commercial. You know, commercial's root word is commerce, which means something that you take revenue from. So many people, when they say commercial, they think of industrial and retail, but it also includes multifamily. So I went along that progression. So what was I looking for? To be able to scale, it's tough to do it with houses, right? The hedge funds learned that even though houses became a new asset class for them, they also realized, as Warren Buffett famously said, I'd buy a bunch of them if I understood how to operate them, right? How to manage them. A lot of these hedge funds, were buying houses in large bulk, and before they could get management on board, they were being copper mined and everything else. So, and the values of the returns on houses came down because Wall Street needed less yields, and you had a bunch of folks that had a schedule for how fast they wanted to deploy money, and so therefore it became a lower return product. And that's when I spent more time focusing on commercial properties. There we go. A lot of principles, I think, that can guide us well in life are not that complex. It's awfully easy to look for really complicated things to guide us in which way we go. But I love simple principles. Here's a couple examples. The Rothschild family at one time was considered the wealthiest family in the world. And in the 70s, one of the grandsons was interviewed and asked, to what did he attribute his family's great wealth? And he said, by selling too soon. So the lesson is, don't be too greedy, right? When something's climbing up, it's always tempting to wait a little longer. But if you've got, if you've got a good profit, successful, velocity of money is important. Keep moving money along for yourself, for your investors, get their money back, take the profit, move on. Yes, you'll lose a little bit, but when it cliffs off, it's catching a falling knife. It's too late at that point. Conrad Hilton, who was the very first one to build an international hotel empire, he was asked to what was the most important thing he learned in building that empire. What do you think it was? That's it. Keep the shower curtain inside the shower. Plan your exit. And that can apply to your business as well as each property. So I'm sure you realize now that when you buy something, you ought to have a plan on when you tend to get out. And you can have a plan B, but that's very important. But also, if you have a business, how are you going to have a successor? How are you going to sell it? How are you going to exit at some point in time? Be very careful what people say who have a high level of influence. Here's Ben Bernanke in 2005 says, we've never had a decline of housing prices on a nationwide basis. What I think more likely is that house prices will slow, maybe stabilize. I don't think it's going to drive the economy too far from its full employment, though. So, of course, got to think about what the motivations are of the person that's saying it, whether it's the chief economist of National Association of Realtors that wants everybody to think that the real estate market's always great, or whatever. We're always wanting high cap rates, low risk, and high appreciation, but it's very hard to find all three. So if you have to decide what it is that's most important to you, California has been able to generate great appreciations in recent years, but not so good on cap rates. And Texas, Florida, other places have other things that are strong. So you need to realize it's very hard to get everything you want. You got to choose which they are. Which is important. One of the most important things I think I've learned is how different submarkets are, and how different products are. it's just, it's incredible how different they are. You look at the curves of these markets and products, and yes, the general information will say, will give you a general concept, but boy, you can always find products, you can always find portions of the market where it can be quite contrarian to what the general information is. Here's so the markets, have cycles, and I think what this demonstrates in this slide is that in the different cycles of the market, there are different cities and different products are quite different timing on where they are in those circles. This happens to be a chart for current office market, what different cities, I know you can't see that in the back, but it just shows a distribution of cities and submarkets, MSAs all around the country, and you can see there are cities in each of the 4 major sectors of the market cycle. So, and you look at retail, you look at industrial, you look at multifamily, same thing. They're all different. So, it's very, very important to look at each product and submarket separately. Let's see, what's this one? Oh, yes. A good example of how things can vary. Here in California, which many of us are from, we know that in the pandemic there was a huge vacancy that occurred and still is in the office sector, especially where there are professionals and it's a work-from-home environment. And so there's some people, and unfortunately a lot of lenders, that say, boy, if it's got the word office on it, don't even talk to me, I'm not interested. One of my 2 office buildings I have is in Savannah, Georgia. It stayed in the 90s all during the pandemic, and it's at 100% occupancy right now. So how can that be? Well, it's the type of tenant. So the tenant is more important than what the asset class is. So if the tenant is in education, community services, health services, so forth, where they have to be on site with the client, that's totally different than work-from-home professionals, right? So you got to really look at the specifics. When Amazon started its explosive growth, a lot of people thought all retail is going to be scraped from the face of the earth, right? Well, so far, I don't think we can get our hair done or get a glass of wine on the internet. So, strip malls and service industries, but even big box. A lot of those have set up complimentary websites. You go to pick up the thing you ordered online at the store, you buy something else. So don't ever broad brush everything just based upon the general headlines. Underwriting, we've talked a little bit about that today. It's incredible how important that is. It's with the assumptions, you can make the results be anything you want, right? Just look at your exit cap rate. So to do a good job, it's really thousands of cells. I always, when I used to do it myself, I'd always take the IRR and cash on cash and copy that cell on each of the sheets where I was making the assumptions, so I can watch that and see if it makes sense which way it goes and by how much, what the sensitivity is. And I always have someone else go do it also and make sure the results come out the same, because the decision of whether or not to invest in something like that is very, very important. Look at just the parameter of the rent roll. We just sold in Houston recently for $50 million, a 6-location portfolio of industrial with 103 tenants. So when you're doing the due diligence on this, you're doing the underwriting, what do you got to do? You've got to look at the rent roll. You've got to look at each tenant, take a guess at whether or not they're going to renew. If they don't, how long is it going to be empty? And when you lease it up again, what price is you going to rent it? And you got to do that for all 103 of them. Not just that part of it. So underwriting is very, very critical. Yes, I agree with the speakers before that execution is critical, but so I I spend a little more than 45 seconds on that part because I'm not as bright as the Yeah, don't fall in love with a deal and try to make it happen. Saying no can be more valuable than saying yes. We've talked a bit about due diligence, and I agree. Someone said that they like to go to the property themselves. Well, most every property I've bought, I've gone to myself. I don't do the level of detail I used to. When you scale, you got to delegate, but it's all to others. But I too go to if I'm buying a property, I go look at the other stores around the area, retail, grocery, whatever. Who is it that actually come in there? You ever get these market studies from the listing agent, and they show you the 1 mile and 3 mile and 5 mile, what the demographics are? That's not necessarily who's in your property. So, as you can tell by going at nighttime, parking the car, and seeing who comes in and out. Now, I can't say that I've seen different colored lights, but I'll look for that next time. When you make a mistake, it's tough to grieve and hurt and lick your wounds for a while, but don't run from it forever. Go back with your team and analyze what is it that went wrong, or what is it we could do better next time. That's ironically, sometimes the things that don't work, we learn more from the things that do. So that's pretty important. And change your model periodically. Switch from market to asset class to another, whatever goes with the times, with the market. I think one of the things I've done that's been contributed to my successes is to go change the model. One of the things I haven't done so well is probably change as fast as I could have. It's hard to leave something that was working. And indeed, what's the most valuable asset that you have? I think it's the 2,000 names that I have in my phone. I think that's more important than anything else, because with those relationships, you can start over if you have to, or rebuild. So yes, relationships are certainly critical, and I agree that character is more important than competence. It's nice to have both, but that's number one. And I concur. Share your information, share whatever you can give to others, help others, and you'll both win. When I was in tech, I had a marketing position for a few years, and this was before internet provided all this tremendous amount of data. And I would write marketing reports about our competition, and my peers said, well, Tom, how in the world did you find out these things from your competition? I said, oh, thank you. It's my little secret. And my secret was I'd ask them. I'd ask my competitors, and I would share information about what I thought they would get some value from me. So if you're Google or Apple, you don't want to lose market share. But if you're relatively small in the marketplace in your business, you both win. I always believe that's important, because abundance is, I think, coming from a world of abundance as opposed to scarcity is very beneficial for all of us. And above all, enjoy the journey. It's so easy to get caught up every day in the operations and trying to make more successes. But along the way, give back, smell the roses. If you ask my daughter what's the most valuable thing that she ever learned from her dad, and she would say, smell the roses every day and enjoy the journey. So I encourage you to do the same. Thank you.
Thanks, Tom. Appreciate you.
Do we have time for a question?
Do we have time for Q&A? Okay. We have 5 minutes. Okay, so we can run the mic. Maybe Elias, you want to run the mic? Anybody have a question for Tom? He answered all the questions.
So you bought your first house in 1970 for the rental. You were really nervous. Today we see prices high, rates are high, and this is a single family question, but where do you think the single family market's going with kind of where the data's at, rates are? I don't know if you can answer that question. I know it's still crystal ball, but just from your experience in all those years.
Well, again, the market is thousands of submarkets. They're going to vary quite a bit. I think, what I'm going to share right now is what I hear and from my conversations with Dr. Doug Duncan from Fannie Mae. He feels that we're not overall, from a U.S. standpoint, going to drop very much. Some markets will, some will stay stable. Right now, of course, the prices are being held up because there's no supply. People aren't going to let go of they're going to move and let go of their locked-in interest rates. So I think the tough part is the same as it has been for 30 years. Me personally, I haven't thought it's been made sense in high-end markets like in California to buy a house for cash flow for 30 years, certainly 20 years. Just look at the rent ratio, look at the revenue relative to your number one expense, the debt service, based on 80% leverage. So it looks to me like we're going to stay pretty stable. Some markets come down a little bit, some up a bit. But again, if you're looking for cash flow, not long-term appreciation, I think you just look at that rent ratio. Yes.
Hi. Oh my gosh. Hello.
Hi.
I'm 23 and I'm just kind of getting into this space. I was wondering what.
It's when I bought my first house.
Oh my gosh, I'm
22,
feel behind
I think
now. Well, what would you recommend, I guess, as a 23-year-old, but also in this time? Would you say that I should focus on just pursuing multifamily, or should I start with kind of what you went first, a single-family route, multiple single-family into multifamily, or diversify? What do you recommend?
I'd say if you want to start off scaling a little higher than just houses, which some people. Back when I started that, it was other than my landlord neighbor who had those houses. That was a very contrarian business model. Hardly anybody. Maybe they kept the first house that they were in, and that was their rental, but that was very unpopular. As time went on, we got to know about that. I don't think there's anything wrong with buying houses. I think you just need to go study all the markets and see which ones get the best returns, which ones have a history and projection of having the highest population growth, economic and business growth, which ones are business friendly. I'd say most of the products in the 24 markets that I've been in, whether they be houses or other commercial properties, have been in the heartland of America, the South. I tend to not like the Rust Belt up north because it's largely had a declining economy, declining population. Sometimes back to simple principles, you can just ask yourself, okay, someone gets a job offer at GE in Utica, New York, and they get one in Austin, Texas. Which one are they probably going to take? So just look at where things are places are migrating. So the trick is, of course, if it has a large inward migration, it tends to drive prices up too. But I think the heartland of America is still fine for single-family homes. And I think, if you scale, or when you scale higher than that, I would say get a partner. Get experts on your team. I think that's really, really critical. I'm a big delegator. I kind of micromanage a bit in the beginning, but once they're on board and I think we're on the same page, then unlike most techies and engineers, I tend to let go and step back. But get a partner, no matter if it's a partner that has more experience, if it's a partner that brings in the capital, get experts on your team.
Thanks, Tom. Awesome. Let's give Tom a big hand for sharing today. It was awesome. Thank you so much.